That's not even that long ago, right? Even just back a year ago. It's flat. There's no real problems. But then, okay, the Fed's hell-bent on slowing the economy down. Where can we generate losses and make people feel pain? I don't know. Well, we control the short end of the yield curve. So let's take those interest rates up. As of August of last year, the curve officially went inverted. I would even argue at this point, banks not really that stressed. But then watch as the short-term interest rates go up. Uh-oh, we got major problems here. And you can see Wall Street is like, we better get the hell out of here. And they have been getting the hell out. And you know, the thing is Powell even said yesterday, we have no plans whatsoever of lowering interest rates anytime soon. So this is a really good example of don't fight the Fed. We have to wait for them to actually stop taking their Viagra and, calm down. Down, boy. Take a cold shower. And we got to get those short rates. And you can see what happens. Look at there, flat. All right, la, 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 la. Actually, I think it went inverted over here. Yeah, inverted. So let's try and calm things down. We want something to break in the economy. And, interestingly enough, this is when they took crude oil to it was like $120, $130 forever ago. And that, I think, is actually what caused the economy to break. And then all of a sudden, all hell breaks loose. Things are breaking, and notice how the yield curve is going back to normal. We go into absolute panic. And, at this point here, all the central planners and stuff were all coming out and just saying, stimulate, bailouts, free money for everybody, get in there and invest. And of course, that's when you had to buy. Interesting how stockcharts.com has kept this on here, because this is another good example. This was the dot-com boom. And interestingly enough, this is our fear, greed cycle pivots. So, sadly, you don't see that on this chart because, of course, this doesn't take into account the dilution of the currency. So as a result, this considers the unit the exact same from here to here. We all know that if you take currency dilution into effect, these highs are nowhere near these highs. These highs are like down here. I've shown you that chart repeatedly, but just to see the effect of the yield curve inverting. So we were getting up top, things were getting toppy. You can see the curve here based on stockcharts.com is showing us that inversion now. Markets up here, and then, all right, we got to take rates. All right, markets break. I mean, look how nasty this is. Markets breaking. You could even argue that this looks a lot like what we are now. And you can see we're just at the start of this. So you got to get to the point where this inversion stuff stops. And actually, interestingly enough, that image right there, sort of right, it'd be interesting. So this was December 2000. That was basically the Y2K peak. And you notice that the stock market bottom was still, that's December 2000. Inverted, markets already broke. That looks very similar to that right now, right? So if we fast forward to here, it's looking pretty darn similar to that. And you can see that we still have quite a ways to go. And ironically enough, we actually have to get to the point, I suppose in here, the Fed said, all right, we'll start lowering interest rates. But ironically enough, they started lowering interest rates. This goes back to normal, but you can see we still have a long way to go before the market actually bottoms. And that's a really good testament. Last night, while we were watching all the Fed insanity there, somebody put a graphic of sort of where we are on our sort of the path of this whole market cleaning itself up, getting back to a base so we can start the whole frivolity all over again. And it was Effie. So his sort of feeling is that, kind of like what I showed you with that yield curve, we are breaking. The Fed, of course, always goes way too far, does way too much. They are starting to break the system. You heard Powell say, I don't have any interest whatsoever in lowering interest rates anytime soon. Through the spring of 2008, late winter, early March, that's actually when we started to get, that's actually when we got the sell signal in the S&P 500. And I famously put out that blog post calling the top there in the S&P 500 back in 2007. I think you can actually make the argument that, yeah, we probably got the moving average cross up here. Let's see. Yeah, there it is. So sell signal up here. This would be sort of my 2007 sell signal off the top. I remember that specifically. It feels like it was yesterday. So we worked our way lower. Interesting if they worked the market up here. Is this a bit of a trap? It might be. I'd probably let those key reversals and stuff play themselves out. I do like the idea of the market rallying into the summer here. You know, sell in May and walk away. So not summer, even just sort of late winter, spring. So here was that 2007. So 2000. So there was the cross. It was in like November 2007. Here is the spring rally. I think this is where we are right now. Uh-oh, SpaghettiOs. Look what we potentially have in front of us here, guys and girls and houseplants. Holy Shiite Muslim. You know, as we said, the Fed wants to break the market. And they even, you know, kind of tragically, they even said, we have no interest in lowering interest rates. I saw the inflation data. The one thing about this particular market cycle, we didn't have to worry about inflation here. It was not that of a problem. This was more of there were way too many mortgages out there. And of course, they started to sort of, subprime. They started to lend money to people that they should have never been lending money to. And then they started to mix all these products together, called them collateralized debt obligations, right? Sort of fancy schmancy talk for, actually, we have a whole bunch of really crappy paper mixed in with a couple U.S. treasuries. So what the hell? Maybe you don't see the crappy paper. It turns out that they did. It is interesting that through this spring period, they were able to rally the market. It might have been interesting to look at the QQQs and see whether you got sort of false head fake buy signals on the QQQs at exactly the same time. But this is a different part of the cycle because remember 2008? Oh, yeah, look at that. We did. So, all right, is the NASDAQ. So there's the same sell pattern, right? October 2007, early 2008. And notice, March, April, NASDAQ came screaming back. Key reversal signals, very bullish price action. In fact, yeah, look, you can see bullish engulfing bar off a 200 period weekly moving average. Big counter trend rally back up against the original top. And notice that topped out in May, June of 2008. Sell in May and walk away. So I don't mind the idea that there is going to be some sort of rally here. It does feel as though that's the case. And in a weird sort of way, actually, I think this all ties in together. So remember we said short Jim? They actually left a price gap on this chart right down at the bottom, which means that, he's long and he's touting long ideas. So is that rally into May, June of 2023? I think that's the year we're in right now. Is that this thing coming down and filling in this gap? And then the market tops out and craps out, right? If we pull up the QQQs, there is the counter trend rally. There is the old highs, right? So we got to go against that weekly chart to see that pattern. And we said in 2007, 2008, they actually rallied the market all the way right back up into the original topping pattern. So could you see this thing sort of over the next, June, April, May, June? So here's that May. There's middle of May. We say famously, the market loves to top out into Chris's birthday. And of course, there are other famous people in this world that have the same birthday. And I think actually it's their fault, not Chris's. So don't beat up Chris for this. But the point of the matter here is, do we get that same rally in the NASDAQ into that May-June window and then roll over following that? I like that thinking. That makes a lot of sense to me. And kind of like what Julian says about liquidity pools, I think you could make the argument there is a massive liquidity pool right there. And there's probably also a massive liquidity pool against there. So you also notice there's Joshua's gaps. So there's lots of reason for them technically to take this thing up. So let's all, if anything, be mindful that once we get to Brian's birthday, be careful here, folks. I do like the idea that the market's going to rally, and I like the idea that, Kramer's going to publicly come out and say, "You idiots, you were shorting me, and I'm so smart, look at me." And of course, all of his fans and, all of the Peter Finks and all those kind of people are like, "Yeah, Kramer, you're awesome, you're the best." And literally, right following that event, the whole damn market's just going to roll over and puke out. I could totally see that happening.